Good morning, everybody. All set up for the day. Good morning. Welcome to another Wealth Coffee Chat, 27th of October. I hope you're all awesome and well. Quick shout out to a few of you guys on already. Karen, Allison, Ashley, Chris, Michelle, Sean, Tony, Adrian. Good morning to you guys. Great to see you guys on this morning. Hope you're all awesome and well wherever you are. Andrew, Stephen, good to see you. Anyone who is new to the show, give us a shout out. If you're there, if you're new, let us know. Putting you in the chat or tell us where you're dialing in from. Jason Witten's my name. Each day, around about 8:05, 8:10. Hey, morning, Tash. Get together with you guys and just talk a little bit about real estate, about the world of investing, and what we can do to be, better investors, maybe. We've got a couple of sayings around here. Buy well, never sell. That's important. And, this thing's a marathon, not a sprint. And I wanted to talk to you guys about that this morning. The idea that, the misunderstanding of capital growth in the world of real estate is something that I see, unfortunately, get in the way of some fantastic property portfolios. And what is expected of certain pieces of real estate, for many of us, we need to sort of understand and realize, what's possible and what potentially isn't possible. And it's not very easy to work that out. Like, let me tell you, because, for me, I've kicked the can down the road for 22 years when it comes to property investing and tried every strategy under the book, in the book, under the rock, I don't know, under the sun. I think I've mixed up my metaphors there. But, renovating, small developments, old properties in cash flow areas, new properties in great areas, whatever it might be. And each one of those properties has a different profile, a different reason for growth or not growth. And what I see often is property investors buy something for cash flow because they're either nervous or they're worried about their income or their cash flow. And then something switches in their mind and they're like, well, the property didn't grow in value. And, you didn't buy it for growth. Your predominant number one reason was buying that property for cash flow. So I want to talk about that tonight. Tonight, hey, I think I need another coffee. This morning, and we'll have a bit of yarn about what that is, because there's three major reasons. Tell me right now, chat folks in the chat, what are the three major reasons? Three reasons, financial reasons, money reasons, why people why you are investing in real estate and the things you expect from it. What are the three things you expect from it? Or maybe you're not sure what to expect from it, but what are the three things, financial things, that property can bring to you and me as investors as a benefit? The three major benefits. Now there's a few other benefits in there, but the three major ones. What's the three things that you can get from it? Anyway, chuck it in the chat for me right now. Time, Chris, okay. Freedom, yes, that's the concept at the end, but I'm talking sort of monetarily right now. Boom, we've got it in there. Ashley and Brendan nailed two of them. All right, so, Karen's all over it there. Capital growth, passive income, financial freedom. Perfect. All right, we got them. We got the three. We're looking at income. Okay, we're buying the property. Andrew, absolutely, we can get leverage out of it for sure. That's kind of like this secondary thing that we can do. We've got an income stream, 100%. I believe rental income from residential real estate is one of the most reliable income streams on the planet. Number two, your growth conversation. Number three, absolutely, the real estate world can be very tax effective in multiple ways. No matter which way you slice it, folks, in this society we participate in. We choose to participate in this this space. There are some rules of engagement, and those rules of engagement are, certainly in your favor if you have real estate in your portfolio, because it's quite effective. It's quite useful for a number of things. But there you go. We've got the three, team. All right, we've got the three things. All right. Income, tick. Growth, tick. Tax minimization, tick. Now, income makes sense. It makes sense to understand that, income is, it's okay. What happens? We get it weekly, from a renter or a tenant, it's quite consistent. The property can grow in value, so we can increase the rent, et cetera, et cetera. There's a few sort of ticks in the box there. I mean, there's not a lot to explain when it comes to rental income, is there? I mean, I was just struggling to come up with, all right, how do I explain income? Well, it's pretty straightforward, okay? These other two are a little bit more complicated when it comes to what do you expect. What do you expect in income? Well, you expect the tenant, you expect the property manager to do their job, and you expect the tenant to pay their rent. And that's kind of about it, okay? Let's talk about this. Concept, in those sorts of terms, all right? Andrew asked a question. When you say portfolio, do people have physical portfolio with documents relating to their assets? Just figure of speech. Probably a bit of both, Andrew. When we're talking on this show, obviously, it's about their portfolio of real estate and, how you take a look at that. So income, fairly self-explanatory, and we shouldn't be confused about income, right? We shouldn't be confused about it. What can you expect? Well, you can expect people to pay the rent. That's fairly straightforward, regularly, and every now and then you might have a vacancy, you might have something, but it's not complicated, right? So let's skip over to the other one, tax. Well, tax in reality is reasonably straightforward, right? So the taxes, the two big ones is capital gains tax, so CGT, and we can reduce our income tax by depreciation. So those two are great. Tick in the box. Okay, if you buy a piece of real estate, it goes up in value, you'll pay some taxes. How do you calculate that? Straightforward. Income tax, all right. Well, if you've got some depreciation, you can minus it off of your income and you can pay less tax. Okay, pretty straightforward. Certainly a little bit more complicated, certainly a little bit more in-depth to get your head around, but, not that big of a deal. And there's some other things. Land tax, if you own different properties in different states at different values, we have land tax efficiency. But, again, fairly straightforward as a concept to understand. Income. It happens weekly and someone's paying it and there's someone watching it for you. All right, great. Taxes. There's certain rules, and if you tick the box and you're inside the borders, you get tax deductions. All right, tick. Great. Growth, the big mystery. The big one where it is so uncertain. Oh, there's uncertain. What is it? It's there's so many different versions of this idea called growth in real estate that it's misunderstood, right? It's misunderstood when it comes to the world of real estate. Here's a few things that I have observed and noticed as a property investor over 22 years. And also, I've had the pleasure of talking with many investors who are a lot older than me, a lot more successful than me, who have been investing 50 years, 60 years, who have, hundreds and hundreds of millions of dollars worth of properties in their portfolios. And, paid some attention. And what we do know, and I think it was one of the first things that came out of on the screen today from you guys. Time. Chris said it, right? The magic word with capital growth on real estate is that you have to give it time, okay? And one of the challenges for me right now, and for you, all of you guys right now, is to make sure that you set in your mind that this moment in time, these couple of years now, these these growth years are certainly normal, but not normal. And what do I mean by that? Let's go and have a look at a chart I prepared earlier. Over since 1970, this is kind of like an indication of inflation, interest rates, and growth, okay? When we have a look at the market, the property market in our, and what this I want to talk through this morning about the idea that can anyone see a direction, a reasonably long-term trend, all right? So if we start around here and we kind of head that way with a straight line, doesn't matter which year you look at it, they're over a 10 to 15 year cycle. If you try and break it down into 10 to 15 year cycles, that trend stays true. Okay, so let's just do this just quickly. And I want to sort of not harp on too long on it, but I just want to show this. So let's look at the 15 to 20 year cycle is the cycle we talk about. When we talk about buy well, never sell, the time factor in your property investing, what does that look like? 1970 to 1990, that's a 20-year cycle, okay? And that was still in, highest interest rate cycles. And if you look at that, if you look at between there and there, have a look at potentially what this might look like. Now, slow but surely, upwards trajectory, okay? That era, when you have a look at the history, if you look at the interest rates and the rental returns on those, it was pretty significant. And then you go to the next, 20-year cycle, 1990 to 2010, which, that's shifting my thing around. 1990 to 2010. All right, I think what's going on here. Oh, there we go. Let's have a look at what is happening there. All right, that 20-year cycle as well. Again, if you look at the starting point, and then you look at the increase, what happened there is we had acceleration of cash rates going down, interest rates going down. And we're looking again. Now we go 2020, we're out to 2030, 2010 to 2030. And again, we've got this trajectory of long term. But when you dive into it, if you have a look at, what happens if you purchased kind of here and it went flat there for, let's have a look at that. When it went flat for 5 or 6 years, what happens when you get exposed to buying? You might think, let's say you purchased right there and you're thinking, all right, I've purchased at the top of the market, and it goes flat for 5 years. And in your mind, in your head, in your ego, you're like, oh, I've made a mistake. This is the worst thing I've ever done. The growth is over. The market's going to fall. It's going to crash. Or even here, I don't know if you can see that one there. It went down a bit and then went flat, for that period of time as well. And then what happened after the GFC? The largest financial crisis the world has ever seen, okay, before COVID. All right, look, in here, if you have a look at, Sydney went down, everywhere went down. And imagine you purchased at the top of the cycle here, okay? And I know a bunch of people who did. Imagine you purchased at the top of the cycle there. that's another 5 to 6 year recovery for the property values in general. And maybe you bought a rubbish property to begin with anyway. So my conversation with you guys today is about this idea of growth and the things that we expect from growth. You got to give it time. A 4 to 5 year window to say, oh, growth, it succeeded or not, is not enough. Okay. Now, for some of us, we've purchased now, and all we're going to know is growth for the next 3 to 5 years potentially. Now, that is a dangerous place to be long term. I want you to make sure you understand if you get 4 or 5 years growth right now, you are going to have 4 or 5 years flat in certain ways or shapes or spaces after the growth process, and maybe even some adjustments down in total market value because it tends to overshoot. Nothing wrong with that. That's normal. That's normal, team. We get some upside, we get a bit of flatness, and then markets move again. That is the cycle of real estate markets, and I just wanted to sort of touch base on that one today to make sure we sort of get our heads around that as we go. And then, Alison sort of talking about that, you get what cash you put into the deal back and hold fast. Now, right, absolutely, Alison. The property will return the dollars in 3 ways, right? It'll give you some tax deductions back immediately. It'll give you some rent. And over time, it'll give you some growth, okay? Return on cash. How fast does that property return the money? If it takes 1 year or 5 years, fantastic. The amount of money you've got in the deal, if it's returned that money, then it's kind of a free hit. It's a kind of it's no cost to you. You own an asset and it'll work and it'll keep working and it'll be consistent over the long term. All right. So there you go. Hopefully that made sense this morning. Just talking about, the time factor in this world. And it was interesting, actually. I found this other little chart about, the stock market as well. And you could see sort of over time, it's more pronounced in the stock market, but, it very similar versions of the world when it comes to real estate. You get a 2 to 3 year down and then you get some momentum long term. But, if you have a look in here, if you bought at the top of the market there and you were across here, you got a big, a dip there, So anyway, charts are interesting. I like charts, but really at the end of the day, the point of today's conversation is we buy property for 3 reasons: create income, expect some growth at some point, and we get some tax deductions. Income and tax deductions are fairly simple to understand. Growth gets confused, and the number one ingredient is time. The number one ingredient is time. The number 2 ingredient is the quality of your property. And then number 3 ingredient is the location of the quality of that property. Get a good property in a good area and give it some time. Those are the base ingredients of that mix when it comes to real estate value. Anyway, there you go, folks. Hopefully that makes sense and landed for some of you today. Well, there you go. Well, I think we'll call it done and dusted. Wealth Coffee Chat done for today. You guys, it's like a cake. Watch us do us things. Thanks, Brendan. Absolutely, mate. You gotta let the cake rise. You've mixed the ingredients, team. Just remember to give it some time and be patient. Be patient. And also, don't rely on one property. That's why we talk about it all the time. Multiple properties, 3 to 5 properties in 3 to 5 different areas, because sometimes some properties in some areas just don't get enough momentum as you go. So, all right, team, that's it. I'm just rabbiting on now. You guys be well. Take care. Be safe. And join me tomorrow for another Wealth Coffee Chat. Till then, bye for now. Adios.